The Fed has no choice, and when the Fed has no choice, smart money moves before the crowd figures it out. Today, I want to walk you through exactly what's happening in the macro environment right now, why a specific corner of the market is quietly setting up for one of the more compelling moves I've seen in years, and why one company that most retail investors have never even heard of sits right at the intersection of some of the most powerful tailwinds in this entire market. And I promise you, by the time we get there, this whole thing is going to click into place in a way that just makes sense. But we have to build the foundation first, because if you just jump to the ticker without understanding why, you're going to paper hand it the first time it pulls back, and you're going to miss the actual move. So stay with me here. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily live streams on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockcommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involve government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, this is not financial advice. Do your own research. Let's start with the jobs report, because this is the engine that's driving everything right now. Most people know that once a month, the government releases employment data telling us how many jobs were created or lost the prior month. What fewer people pay attention to is what happens once a year when the government goes back and reconciles those estimates against actual employment records. They call it the annual revision, and the revision that just came out was, to put it plainly, one of the worst economic data prints in recent memory. The prior year's job creation numbers were overstated by over 1 million positions. 1 million jobs that the official data told us existed simply were not there. Now, earlier in this cycle, we'd already seen a similar revision come in at over 800,000 jobs overstated, and the market was rattled by that. This one was bigger. And what that means, when you strip away the noise and focus on what the data is actually telling us, is that the economy has been considerably weaker than the narrative suggested. We were told we had a resilient labor market. We were told the soft landing was working. And now the actual numbers are saying the foundation was not as solid as we thought. Here's why that matters enormously for investors right now. The Fed operates under what they call a dual mandate. Their first job is controlling inflation, making sure prices do not run so hot that they destroy purchasing power. But their second job, and I would argue the more important one in this environment, is protecting the labor market. When unemployment data comes in this week, the Fed does not have the luxury of staying on the sidelines. Their hands get tired. They're essentially forced to cut interest rates to stimulate the economy, to make borrowing cheaper, to encourage businesses to hire and spend and expand. And when that happens, certain sectors of the economy do not just benefit modestly, they ignite. They've been sitting in compression, waiting for this exact catalyst. And when the fuel hits the flame, the move can happen very fast. Now, before I tell you where that money's going, I want to give you the broader picture of where we are right now, because the context matters and is genuinely unlike anything we've seen before. The World Uncertainty Index, which measures how frequently the concept of uncertainty appears across global economic reports, just hit an all-time high, higher than September 11th, higher than the 2008 financial crisis, higher than the COVID pandemic in 2020, and it's not even close. This index has absolutely rocketed above every previous peak in its history. When uncertainty is elevated, it compresses investment, it slows economic growth, and it creates financial volatility that can feel completely disconnected from fundamentals. You've got geopolitical tension in multiple parts of the world simultaneously. You've got tariff policy that's creating real inflationary pressure in the near term. with companies like Levi Strauss and McCormick and Columbia Sportswear all announcing price increases, some of them in the high single digits. You got the biggest tech names in the world being whipsawed by two contradictory fears that are somehow both in the market at the same time. And that contradiction is at the heart of where the opportunity actually lives. Here is that contradiction. Fear number one is that artificial intelligence is so powerful and advancing so fast that it's going to displace enormous portions of the existing economy. Software companies, media companies, knowledge workers, all of it potentially at risk. And there's real evidence for this fear. Companies like Adobe are down roughly 60% from their peaks. ServiceNow has been cut in half. The argument being made by serious, well-capitalized institutional fund managers that AI tools have become capable enough to replicate and modify existing software, which means legacy software companies are facing competitive pressure, not just from startups, but from their own clients who are now building custom tools in-house. They even have LLMs in the government. This is an existential shift. Fear number two is the exact opposite, though. A record 25% of fund managers now believe that companies are overspending on artificial intelligence, that the CapEx is running ahead of the returns, and that this is the defining market risk of the moment. Amazon just ended its longest losing streak in its entire history as a public company, falling for 9 consecutive trading days and shedding roughly $450 billion in market value. And the core anxiety behind that sell-off was CapEx. Investors looking at the hundreds of billions being deployed into AI infrastructure and asking whether the returns will ever justify the spending. SoftBank sold off its entire NVIDIA position. Now, technically, they did this back in October, but the official 13F confirmation just hit, and the headline alone was enough to send a chill through the market, even though SoftBank simply locked in a generational gain. So you have two fears running simultaneously. AI is going to destroy everything, and also AI spending is a bubble. And here's the thing that most people are missing. Both of those fears can be true at the same time and still point you towards the same opportunity. The technology can be genuinely transformative, and the valuations of the companies selling software subscriptions can be stretched. The CapEx boom can eventually slow, and the physical infrastructure being built right now still needs to be built. There's a layer of the AI economy that is not a narrative. It's not a valuation story, it's a physical requirement. The GPUs that power OpenAI's models, the data centers that Meta is building to run its advertising AI, the networking that connects all these chips together inside those facilities. All of that requires actual manufactured hardware, fiber optic transceivers, precision optical modules, high-speed cables, complex electronic assemblies built to tolerances that most manufacturers cannot hit. You cannot train a language model to replace that. You cannot offshore the precision away. It either works at the spec or it does not, and the companies that can hit that spec for the biggest and most demanding customers in the world have a moat that the current moment of AI anxiety supply simply cannot erode. And this brings me to the rate cut story and why these two things, the macro catalyst and the infrastructure opportunity, are converging right now in a way that I think creates a genuinely asymmetric setup. So when the Fed cuts rates, and based on the jobs data they're going to, the first and most obvious beneficiary everybody talks about is housing. And they're right. The construction and building materials sector has been one of the strongest performing areas of the market over the past several weeks. With lumber up roughly 10% in a very short window and building product ETFs accelerating to the upside, the logic is simple. Mortgage rates come down. Buyers who've been sitting on the sidelines for 2 years finally enter the market. Builders break ground, suppliers fill orders. It's the most direct transmission mechanism from Fed policy to economic activity that exists. And the money flowing into that sector right now is institutional money that has done this math and is getting positioned before the consensus catches up. But there's a second transmission mechanism that gets less attention. When rates come down, the cost of capital for large infrastructure projects goes down. The multi-year, multi-$100 billion build out of AI data centers becomes cheaper to finance. The hyperscalers, the Metas and the Microsofts and the Amazons, find their debt service on those projects is lower, which makes the return math look better, which sustains or even accelerates their spending. And the companies that actually manufacture the physical components for that build out, the ones that are doing the genuinely difficult precision work that cannot be commoditized, those companies see their order books stay full and their margins improve as their own input costs come down with rates. And I want to zoom out for a second and talk about what institutional rotation actually looks like in practice, because I think retail investors often misunderstand it. When a dominant trade starts to lose steam, and right now the dominant trade of the past 2 years, which was concentration in a narrow band of mega cap tech names, is absolutely showing signs of fatigue. Institutions do not go to cash and sit on their hands. They rotate. They find the next sector that has a credible macro catalyst, genuine fundamental support, and has not yet been crowded by retail flow. And when they rotate, they often do it quietly. The stocks move before the reason's obvious. The sector strength shows up in the data before it shows up in the headlines. And by the time CNBC is running segments about why this sector is the trade of the year, the institutional money has already been in for months. Right now, if you're watching where sector strength is actually appearing, not where it's been, but where it's newly emerging, you're seeing building products, the basic materials, construction-related plays all rising up the rankings. And you're seeing precision manufacturing and infrastructure hardware get renewed attention from the same fund managers who've been rotating out of software. Now, there's one more piece of context I want to give you before we get specific, because I think it completes the picture in an important way. Commercial real estate is quietly becoming a systemic issue. Default rates on office loans and commercial mortgage-backed securities just hit their highest level since tracking began. The concept of extended pretend, where lenders keep rolling over troubled loans rather than realize the losses, is breaking down. More than half of commercial real estate loans coming due this year are expected not to be repaid at maturity, compared to roughly 3/4 the year before and over 80% the year before that. Lenders who've been patient are now moving toward foreclosure and liquidation. This is meaningful for the banking sector, and you're already seeing fund managers position for weakness in major bank stocks as default rates spook investors and lower rates pressure net interest margins. The money coming out of financial stocks has to go somewhere, and where is it going? Increasingly toward companies with durable physical businesses, genuine competitive moats, and exposure to secular growth that does not depend on a healthy credit cycle or commercial real estate recovery. That is the profile that is attracting capital right now. So let me tie it all together with the specific name I've been building towards, because now the setup should make complete sense. The company is Fabrinet, ticker FN. It's a precision optical and electronic manufacturing company. They build extraordinarily complex components for some of the most demanding customers in the world. Their client list includes names that are at the absolute center of the AI infrastructure build-out. When NVIDIA ships products that need to communicate across a data center at the speeds required for large-scale AI trading, those optical networking components often run through Fabrinet's manufacturing capabilities. When the hyperscalers build out their next-generation facilities, the precision assemblies that make those facilities function are often coming from companies like Fabrinet. It's not a speculative bet on whether AI adoption will happen. AI adoption is happening. The physical infrastructure required to support it is being built right now, and the demand for what Fabrinet makes is structural and growing. Layer on top of that a rate environment that's about to shift in their favor, capital costs coming down, customers with cheaper financing for their build-out projects, and an institutional rotation that's actively looking for exactly the profile that Fabrinet represents: a real company, a physical moat, durable blue chip customers, and exposure to a secular trend that is not going away. Meanwhile, the broader sector rotation we've been discussing, the construction and building materials wave, the rotation out of financials, the move away from software and towards infrastructure hardware, all of that is creating a rising tide for exactly the corner of the market where Fabrinet operates. The Fed has no choice but to cut. The jobs data has made that clear. The rate cuts will ignite the real economy and reduce the cost of capital for the infrastructure projects that drive Fabrinet's revenue. The AI build-out will continue to generate physical hardware demand that cannot be disrupted by a software update. And the institutional money rotating out of legacy tech and financials needs somewhere credible to go. Fabrinet sits at the intersection of all that. That is the setup. So what did I miss here and what would you push back on? Let me know in the comments. If you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute lives at 9:30 a.m. on market analysis, head over to stockscommunity.com. Try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share here on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear. Do your own research, size your risk appropriately, and never put more on the line than you can afford to lose. But if you've been looking for a place where the macro, the sector rotation, and the fundamental business all point in the same direction at the same time, this is worth your attention.